Hey everyone, welcome back to Corporate Decoder, the place where we untangle the confusing world of finance, and today we're diving into a report that is all about loans and how they're being used to build something big, or maybe just refinance what is already there, wink wink. Get ready because we're about to break down a filing from Belpointe Prep LLC. This report is essentially a status update on some major financial moves they've been making, specifically around a pretty significant development project. So what is going on here? It looks like Belpointe Prep, through one of its subsidiaries, has entered into some new loan agreements. Think of it like this: they're taking out big loans, sort of like getting a mortgage for a huge construction project. The big news is that on the 29th of September, a company called BPO's 1991 Main LLC, which is part of Belpointe Prep, got a variable rate mortgage loan totaling up to $163.3 million. This loan is tied to a development called Astor and Links in Sarasota, Florida. Now, they're calling this a variable rate mortgage, which means the interest they pay can go up or down depending on market conditions. It is a bit like having an adjustable rate mortgage on your own home, but on a much, much larger scale. And here is an interesting tidbit. Their Class A units are traded on the NYSE American under the ticker symbol OZ. This tells us it is a publicly traded company, and these kinds of filings are what investors need to see to understand what is happening. Also, Belpointe Prep is identifying itself as an emerging growth company. This can mean they have a bit more flexibility with certain regulations, which is something to keep an eye on as they grow. Let us get back to those loans. So with this $163.3 million mortgage loan, about $114.1 million was immediately used to pay off an existing loan they had with Bankosk. This is a common move. They're essentially refinancing their debt, swapping out an old loan for a new one, likely hoping for better terms or more flexibility. The interest on this new mortgage loan is based on something called Term SOFR, which is a benchmark interest rate plus an extra 1.5%. Term SOFR can fluctuate, so their monthly payments could change. The rest of the money from this mortgage advance and any future advances can be used for leasing out the commercial parts of their Astor T Links project, for capital spending, paying back other debts, and other expenses related to the project. This mortgage has an initial due date of the 11th of October 2027, but they have the option to extend it for 2 additional years provided they meet certain conditions. Imagine having that kind of flexibility on your home loan. But that is not all. There is also a mezzanine loan involved, BP Mez 1991 Main LLC, which is the parent company for BPO's 1991 Main LLC. Also got a mezzanine loan agreement with the same lender for up to $40.8 million. This mezzanine loan is essentially secured by a pledge of BP Mez 1991 Main, S ownership stake in BPO's 1991 Main. Think of it as a second layer of financing, often riskier than a primary mortgage, and it usually comes with higher interest rates. And guess what? A portion of the money from this mezzanine loan, $34.6 million plus $17.1 million from the mortgage loan, was used to pay off yet another existing loan, this time from Southern Realty Trust Holdings, LLC. So another refinancing. The interest rate for this mezzanine loan is also variable, tied to Term SOFR, but this time it is plus a higher 6.75%. That significantly higher interest rate reflects the increased risk associated with mezzanine debt. The company mentions that full details of these agreements will be filed later in their quarterly report. That's where we'll see the nitty-gritty. This whole filing is under an item that essentially says they've created a new direct financial obligation. That means they've taken on new debt that will show up on their company books. Now, let's quickly look at the signature. It is signed by Brandon Elikoff, who is the chairman of the board and chief executive officer. This tells us the top leadership is aware and responsible for these financial dealings. So, what is the big picture here? Belpointe Prep LLC is heavily involved in a major development project. They've taken out substantial loans to fund it and to pay off older debts. They're essentially rolling over debt and potentially consolidating it into fewer new agreements. The total amount of new debt is substantial, over $200 million when you combine the mortgage and mezzanine loans. The key question is what this means for their future. On one hand, securing significant financing for a development project is a good sign that they believe in its potential. Refinancing existing debt can also lead to better terms and a more manageable debt structure. However, the variable interest rates mean their debt servicing costs could increase if interest rates continue to climb. And the fact that they're redoing so much refinancing using new loans to pay off old ones can sometimes indicate that their existing cash flow might not be enough to comfortably service their current debt. Or they're re-seeking more favourable terms because the old ones weren't working. They're reprojecting future revenue for this project, and these loans are an investment in making that happen. The success of Asta and Lynx will be crucial to whether these large loans are a brilliant move or a risky gamble. Alright, that is our breakdown of Belpointe Prep S latest filing. What is your take on these new loans and what they signal for the company, S Future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.